Hey, what's up, high yield dividend warriors? Today we're not actually going to be talking about dividends, but we are going to be talking about options premiums. We're talking about something that's completely changed my investing game. I'm talking about generating income with covered calls and cash secured puts. Now, if you own a lot of these high yielding income ETFs like a QYLD, a JEPI, or an ALTI, they're basically doing this strategy that I'm going to be talking about today, but you can actually make a lot more income potentially and save a few bucks by not paying expense ratios if you do it yourself. That's why we're going to be talking about covered calls and cash secured puts. And don't get too intimidated by these big fancy names, guys. The strategy is actually pretty simple once you understand some of the basics, and I'm going to show you exactly how to do that with my personal favorite stock, NVIDIA. Time allows us to learn, grow, and get rich when cow pounding works its magic. We're not looking for the next get rich quick schemes. We're building a reliable system to create consistent cash flow week after week, month after month, and that's what I've been doing here lately with NVIDIA. This is the NVIDIA playbook. Now listen, I've been holding my 300 plus shares of NVIDIA since 2019. Yes, if I ever sold, I'd pay quite the hefty tax bill. That's why I just plan on holding my shares of NVIDIA. Now, it's always been a great company. Just as a warning, I would never do this options trading strategy on companies that I did not believe in for the long run. I still think NVIDIA will do great for years, decades to come. So that's why I'm very comfortable doing this options trading strategy with NVIDIA, but I wouldn't do it with other flimsy Wall Street bets type stocks. So today, NVIDIA trades for about $174 a share. Now, NVIDIA is great to just keep in my portfolio, but at the same time, it pays a 0.02% dividend yield. That's basically getting paid nothing to just own the stock. Now, of course, it's totally fine because NVIDIA's share price just continues to keep going up and up. This is where covered calls and cash secured puts become super powerful because they are even better than dividends if you play it correctly. They are like a financial cheat code. I know, guys, the cheat code finally comes out for real this time. It's like generating extra cash from your stock. So let me talk you guys through how it works. So covered calls, we'll start with them first. It's getting paid to wait. A covered call is the simplest way to get started in this strategy. It's when you own at least 100 shares of a stock and you are selling someone else the right to buy your shares from you at a specific price in the future. In return, they pay you a cash premium that you always get to keep. Since I own over 300 shares of NVIDIA, I could actually sell up to 3 covered call contracts at once, and I get to collect all the premiums for each one right away. And if the stock price doesn't hit my set strike price, the option expires completely worthless. I get to keep the premium, I get to keep all my shares, and I can sell another one next week. It's like getting a mini paycheck from your own investments. Now let's talk a little bit about the pros and cons of this strategy. So the pros is that I get instant cash flow. I get those premiums, those juicy premiums right away. And of course, it's just passive income. It's a fantastic way to generate income while you're focused on life. This is very minimal time commitment. Now, of course, with anything in life, if there's a lot of pros, there's tends to be a lot of cons as well. One of the biggest cons is that there's capped upside. So if the stock skyrockets past your strike price, you might have to sell your shares and miss out on some of those big, juicy gains. It is a trade-off, but remember, you still make a profit if it's above your cost basis, and you get to collect those premiums. And there's still downside risk. This is going to exist whether or not you do covered calls or not. You can lose money if the stock price drops, but the premium helps soften that blow. So let me give you an example of a covered call that we could potentially do this week, right? So again, NVIDIA trades at $174 a share. So if I filter this to just calls, this is on the Fidelity platform here. And let's just do 1 week out, right? So September 5th means it's going to expire in 5 days. We can see here, if we sell a call on NVIDIA, we could get $272 in our pockets right now if we do a very aggressive strike price of $175. Let's say we're actually bearish on NVIDIA. We actually think it's going to go down. Then it makes sense to be selling a call on NVIDIA at $272, right? Because let's say by next Friday, the share price ends up being around $170. Well, in that case, you still get to collect the $272 and the contract expires worthless. But if you're like me, I tend to play these a little bit more conservatively. So for me, if I was doing this, I probably would hover back around here, right? $190, and I get $13 for each contract. Remember, I could do this times 3 since I own 300 plus shares. So that's actually about $40 in my pockets. And if you just keep doing this week after week, it does add up to a large amounts of dollars. But of course, you can make more money the more aggressive you get. Now, if you get really aggressive, let's say, we know today's starting price is $174, but you're just very bearish on NVIDIA. Or if you were planning on selling your shares anyway, you could do something that's already in the money. Let's say we do this $172.50 expiring this Friday. So that means on September 5th, NVIDIA is now trading at $180. Well, we're going to have to lose our shares because we've given away the rights to them via that options contract. So now we've lost all that upside of 172 to 180, right? Because we gave it away at 172. So we lost around $800, $750 in upside. But we do gain all of this premium. So it's beneficial if you didn't want to hold on to the shares, or if you just wanted to get rid of it, or if you just wanted to take an increased level of risk. So that's the covered calls. Let's flip the coin and talk about cash secured puts. So if I change this to puts and let it load here a little bit, go down back to the 175 range. So cash secured puts are kind of the opposite, right? So a cash secured put is when you want to buy a stock that you really love and you can get it at potentially a better price. You sell someone a put option promising to buy their shares at a specific price in the future, and then they pay you a premium for that promise. So this definitely comes with some pros, right? You get paid to wait. If the stock never hits your desired price, you get to keep all the premium and the option expires worthless. You also get to buy at a discount. If the stock price drops and then you get assigned, you're basically buying a stock at a discount for the price that you already wanted, plus you get to keep all the premium. It's like getting a discount on your dream stock. And then it also makes it a little bit more efficient. Some people prefer cash secured puts because they don't require you to own the stock beforehand, and they could be a little bit more capital efficient. Now, there are, of course, going to be some cons as well, right? There's the obligation to buy. You are obligated to buy the stock if it drops below your strike price. That's why you should only do this on companies you actually want to own in the long run. And then there's going to be limited profit. Your max profit is the premium you collected. You don't participate in any of the stock's upside if it goes up. So let's talk about a cash secured put here. So going back to our example, NVIDIA is trading around $175 a share. All right, so let's say we're somebody that really wants to buy more shares of NVIDIA, but we don't think it's at a good price right now. Let's say we actually think the better price is $165. What if you got paid to only be able to buy it at $165? That actually seems like a pretty good bargain. So what this is saying is by September 5th, if the price drops below $165, then we're going to be buying those shares at that $165 strike price. And in exchange for doing that, we get the juicy premiums of $60 because it's 100 shares times the 60 cents that you see here. So it's going to be $60. Now, there's always a risk that NVIDIA actually tanks, right? And by the end of September 5th, it could be at $155. Well, our cost base is now going to be $165. So there's always going to be a trade-off. But remember, guys, you can choose how aggressive or how conservative you want to be. Now, recently, I have made some serious profits from doing options trading on NVIDIA. And you guys know they just announced earnings. Now, this creates some serious high volatility moments because earnings announcements can cause some big price swings up or down, and options prices, the way that they're actually calculated is from expected volatility. And this allows traders to profit from either direction. And that's exactly what I did. First, I sold 3 covered calls on NVIDIA at a 202.5 strike price. This was about 2 weeks from their earnings call when NVIDIA was trading at $180. This means NVIDIA would have had to go up 12% after earnings, something that I personally did not think was happening. But there have been situations where NVIDIA has went up that much after earnings, so you are taking a little bit of a risk. Plus, NVIDIA is a ridiculous $4.2 trillion market cap company. For them to add 12%, that would mean that they're adding about $400 billion in market cap earnings in one announcement. There's a fat chance of that happening. For a comparison, Costco is about $400 billion today in valuation. Did you really think that NVIDIA would be adding a whole other Costco after one earnings announcement? Unless there's some free samples of gaming chips being handed out, I doubt it. I also got paid handsomely for this, so each contract was for $111. And since I was able to do 3 contracts since I own over 300 shares, you times that by 3, I got paid $333 in all. Making that much money in just a few seconds from swiping on my phone is a great feeling. And again, this is considerably more than I would have ever gotten paid in dividends. And this was just a 2-week time commitment. What a great feeling, guys. But I didn't stop there. I also pulled the same strategy on the cash secured put side. I sold a put this time on NVIDIA at 160 strike price and got paid an additional $50. For this strategy to lose, NVIDIA would have now had to drop 12% after earnings, which I also didn't think would happen. And I was correct. NVIDIA barely moved after earnings. Much of the hype or disappointment had already been priced into the stock. So altogether, I made $383 off NVIDIA's earnings, despite NVIDIA remaining flat. And guess what? When the markets open up again next week, what am I gonna do? I'm gonna do it all over again. I'm currently riding well over 100 contract win streak, and I've made several $1,000s in premiums doing this. I know you guys love dividends, but for those that correctly can understand and have a good risk appetite of options, options can certainly be way more profitable than dividends ever could be. Remember guys, this isn't magic. This isn't a get rich quick scheme. It's called a strategy. It's about being smart, disciplined, and consistent. I've had a lot of huge successes with NVIDIA shares, and you can apply these same principles to other stocks that you believe in. Now, if you want to learn more about this and how to do this step by step and get full access to my nearly $300,000 stock portfolio, be sure to join my Discord and my Patreon. It's in the link below, and it's a chance for you to build an income generating machine. So make sure you hit that like button. For a small-time YouTuber, subscribe to the channel. Leave a 5-star review if you're listening on the Collect Cash podcast.
And I look at my wife and I told her, I said, honey, we're going to be rich. Not just rich, we're going to get filthy rich. It's crazy how rich we're going to get.